Hello, this is A3 Income Statement and Retained Earnings. Chan Chapter 2 has good information on this. Khan Academy has some interesting videos. Investopedia has some very quick little videos that will make you understand in very quickly what the income statement is. Just like the balance sheet, this is an SEC requirement of U.S. publicly traded companies. It's a flow concept, meaning it takes place over a period of time. So we might talk about quarterly income, say first quarter of 2018, or annual. When we look at the annual reports, we are talking about annual income statement. At its very simplest, then, so the income statement is a reporting of revenue and costs. And if we want to go back to our simple economic model, imagine it was a company with one good that would have one price. So then revenue is price times quantity, where Q stands for output of the good. Of course, a modern company will have revenue from multiple sources. So that's too simplistic, but that's the general idea. And then on the cost side, we divide cost into several categories. The first one is something called cost of sales, which is the costs of the business that are directly associated with the production of output. So wages and raw materials. If you didn't have these, you wouldn't be able to make an output. And if you subtract cost of sales from revenue, you get something called gross profit. So that would be revenue minus cost of sales. And this is considered the part of the income statement that maybe engineers have the most influence on, because they are particularly involved in trying to make sure that cost of sales is as low as possible. You can calculate the margin, so that would be the gross profit, let's just call that GP, divided by the revenue, multiplied by 100. And that will give you a percentage of gross profit as a percentage of revenue. And so then the next thing, obviously you're thinking, well, there's more to making goods and services than just the direct cost of, and of course they are. And the other costs are sometimes called overhead. And then I think on most income statements in the US especially, they are called operating expenses. And these would be things that are necessary for the operation of the business but don't directly contribute to the production of goods. So this could be any kind of administrative expenses. And then one of the things that goes in here that people are sometimes surprised about, but depreciation goes in here. Depreciation, so that's an accounting for the aging of the owned assets. And the reason for that is you need the assets in order to produce the output, and they are going to depreciate in value as you use them, and so over the course of years, and so they're basically a cost of doing business. So that would be the overhead. So if we were to, so one of the things we could do is we could take gross profit and subtract operating expenses. So gross profit, we've already subtracted the cost of sales, and we get a different definition of profit, which is where are we? Gross profit minus operating expenses. That we call that the operating margin. And again, we can get it as a dollar amount, but if we take it as a percent of revenue, we can get another measure of profit. And you might be thinking, well, why bother with all these different measures of profit? Well, it can be quite useful. You can compare your company to other companies in a similar line of business with a similar business plan. And if your company has, mediocre gross profits relative to other companies, but seems to make it up on the operating expenses, you can identify maybe the source of problems. If your company has them, you say, well, the problem lies in cost of sales, but this company seems to be doing a really good job keeping a track of its administrative expenses or something like that. So you can sort of use it to try and figure out if the company is doing well, why it's doing well, and if the company has problems, then where the problems are coming from. And then finally, to get to something that we call the bottom line, which is net income of the company, the last type of cost is sort of financial expenses associated with running the business, maybe interest payments on long-term debt, expenses. So if we take the operating profit and subtract these financing expenses, we get the, ultimate definition of profit, if you like, that is sometimes called the net margin, or sometimes called the bottom line. So again, if we take that as a percentage of revenue, we get a percentage value for profit, and this is called the bottom line. And we can look at that in terms of the profitability of the company. Do we want to invest in it? Does it seem stable? Would we like to work for them? In terms of retained earnings, I know it's going to be a little messy, but at the very end of an income statement, you'll sometimes see a statement of retained earnings. And briefly, what you can tell is after the profit has been earned, which is the bottom line, after what do you do with the money? And the two main things that happen is that sometimes the money goes out to shareholders in the form of dividends, so it's paid out, and otherwise it's retained. And when it's retained, it can be used to grow the business, invest in new plant and equipment, maybe acquire other companies. And there are sort of general rules for who pays out dividends and who retains earnings and tries to grow the company. I guess, sort of simply speaking, you could say companies that are growth companies, meaning maybe they're early in their life cycle, tend to retain earnings in order to grow the companies. Companies that are considered mature, a good example would be, say, an electrical utility. There's not a whole lot of dynamism going on maybe there, and the people who buy that stock are doing so, maybe elderly people who are retired, they're doing so with a view to earning dividends that they can use to fund their lifestyle. All right, so that's the income statement and the statement of retained earnings.